My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be able to make friends. I'm just trying to make you a little money. My job, not just entertain, but put days like today into context. Call me, 1-800-743-CNBC. Tweet me, @Jim Cramer. The line is drawn. The curse is cast. The slow ones now will later be fast. As the present now will later be past. The order is rapidly fading. And the first one now will later be last, for the times they are changing. Yeah, just think about it. When Bob Dylan wrote those words in 1964, I know he wasn't singing about the stock market 60 years in the future. But what can I say? The times, they are changing. The guy nailed it. Because as the Federal Reserve changed its tune yesterday, it destroyed the old order of what was working. Sure, you can't tell from the bullish behavior of the averages. Dow gaining 158 points, S&P climbing 0.26%, Nasdaq advancing 0.19%. But the turmoil underneath was absolutely shocking. This was not a market led by the Magnificent Seven. Apple caught a very bullish piece of Wall Street research, yet the stock did nothing today. Amazon got slammed off 0.95%, even as we're hearing nothing but good things about the holiday season. Alphabet took it on the chin, down about 0.5%, despite just unveiling its exciting generative AI tease. Advertisers have been fleeing Twitter, now X, for Meta platforms. But that stock still also fell nearly 0.5%, down a lot more at one point. Microsoft probably has the most solid portfolio of software out there, as well as huge investment in the pioneers at OpenAI. But its stock plummeted 2.25%. NVIDIA, the king of the semis. But the times, they are changing. Stock did next to nothing today. Only Tesla mounted a meaningful rally up almost 5%. Is it an aberration? No. It's an explanation. On the last conference call, Elon Musk bemoaned how higher interest rates were causing a slowdown in car purchases. But yesterday, when Jay Powell effectively ended his historic tightening cycle, he changed everything for the stock market. Now rates are going down again. Tesla's biggest worry? Well, I got to tell you, it is gone. Remember, one of the main reasons everybody loved Magnificent Seven was the fact that, the exception of Tesla, they are immune to the Fed's rate hikes. Immune. They all had something so special. Even when rates went higher, their franchises weren't impacted. That's why we love them. Of course, the companies won't be impacted if rates go lower either. But their stocks will, because there are so many other parts of the economy that do better with lower interest rates that the money is going to shift from the Magnificent Seven, as it started yesterday and did today, and go to these other stocks. So many stocks. Look, the slow ones now will later be fast. That the order of stocks simply changed on a dime. And it left a host of new winners in its path, winners that had been total losers until 2 p.m. yesterday, when the Fed issued its statement. These stocks were formerly roadkill because they needed lower rates in order to prosper. We look at our own portfolio for the Charitable Trust, the one you can follow by joining the CNBC Investing Club, which I wish you would do, and the new leadership jumps out like, I don't know, maybe like a bull on a railway. Take Ford. Poor Ford. Oh. Stung by labor costs, walloped by electric vehicle expenses, crushed by extraordinarily high auto loan rates. Now, though, there's nothing to pity about Ford. It's all changed. Its customers can get cheaper financing to buy its vehicles. Its sales won't take a hit from the hard landing recession, because that's not happening. They love the hybrid F-150. And meanwhile, the stock sports a 5% dividend yield. Right now, 5% is competitive with what you can get for short-term treasuries. But once the Fed starts cutting rates, oh my, that 5% is going to look a lot more attractive. And that's how the stock of Ford rallied 7.47% in one day. And then there's Caterpillar. Cat was once the bane of the Charitable Trust's existence, as bears endlessly lean on the stock, egged on by a host of negative analysts. You think that stock's up more than 6% today because the company's doing great right now? Wrong. Cat's roaring because of what's going to happen in the future as rates come down. Specifically, the shorts are just terrified. They're just frightened. They're so scared. They're frantically buying the stock hand over fist in order to close out their positions before the bearish analysts go and capitulate, and they'll go from sell to buy. A double upgrade. Who can blame them? Everybody thought Cat had too much inventory for a slowing economy. Now it's just enough inventory to handle a fine economy, with tons of federal infrastructure orders coming next year. Not to mention new business from home builders and road builders. And that's how Cat stock could rally a glorious $17 a share. Or Foot Locker. Today, all all sorts of consistent retailers saw their stocks get mauled. But how about a struggling outfit like Foot Locker, which suspended its dividend and has seen a dramatic deceleration in sales? Stock fell from $42 in May to under $15 in its August lows, thanks in part to worries about how a hard landing would hurt their more downscale customer base. Foot Locker looked like the goner, despite the hard work of Mary Dillon, the incredible former CEO of Ulta Beauty, who was brought in to work her turnaround magic and succeeded wildly. Foot Locker's been treated like a piñata by the analyst community, bashing it with one price target cut after another. Today, though, Piper Sandler, perhaps sensing the zeitgeist at the moment, upgraded Foot Locker, saying the markdowns will soon be history and the newness will be the theme for 2024. They say the crisis is it's off the table. No wonder the stock rallied nearly 10%, one of the biggest gains in the index. But my favorites are the two franchises that have been overlooked forever because of higher rates. Two banks, Wells Fargo and Morgan Stanley, which both rallied about 6% today. That move got me thinking about Wells. Now, many of you are probably either don't remember or maybe too young to remember when Wells Fargo was by far the best bank in this nation. One that Warren Buffett used to own as a huge position. See, back in the day, Wells would always rally furiously at the end of every rate hike cycle. You had to own Wells. These days, because of all the ne'er-do-wells, all the terrible things they did, most view Wells Fargo as a Prometheus bound in red tape and government investigations. But those are almost over. And now we can see how Prometheus Unbound works, with the stock perhaps headed back to the 60s where it was 5 years ago in February 8th of 2018. Not many large bank stocks can rally $2.75 in a single day. As for Morgan Stanley, Wall Street assumed that last quarter was horrendous. Stock had been sinking for months and then cliff dived from 80 to 70 after earnings. I defended it, saying you'll have to wait. You can't. When a more normal environment is going to do better. What happens when Shein and Viore and Databricks and Stripe and General Atlantic come public? What happens when its wealthy clients want to investigate? What happens when the Fed stops tightening? Well, today we found out Morgan Stanley soars up $5.41. This shocking revaluation is happening everywhere. The solar stocks, led by Enphase Energy, they've been cut in half because most people thought they were solar stocks. No, it's about financing. That's right. The solar stocks were really placed on interest rates, and those rates got too high. Now we know rates are going lower, and that's how Enphase stock could rally 12% today after nearly 8% yesterday. These are amazing moves, people. You know, some of these are maybe too outsized. You're getting all the performance you could dream of over the course of a month or a quarter or maybe even a year, I don't know, in one day, one afternoon. It can't stay that way. In fact, we'll probably even see return to some Magnificent Seven money before they report, although the stocks will likely be rebounding from a lower level. And I don't think the suddenly hard-hit enterprise software stocks will go away that quietly. But the bottom line of this incredibly exciting 48 hours, we know that when we have leadership from the banks, earth movers, and shoe stores, that the times, they are a-changing. And to me, it's a reminder, once again, you got to stay diversified. Because after yesterday, there is a pulse outside of the Magnificent Seven. Mike in Illinois. Mike.
Cramer, how are you? Happy holidays to you and your family and all the investment club members and all your employees.
Thanks, big guy. What's happening?
Joined the club about 3 months ago. I'm real happy. I've been listening to you for probably 5 years. I finally decided to join.
Thank you for that. Thank you.
And,
like all my friends in Texas that I saw last weekend who are so many members.
There you go. Listen, I bought Walmart back about 6 months ago. I added to it about 2 months ago. It has not done well. I'm a little above water on it, but the question is, I'm thinking about getting rid of it and getting Costco instead. What are your thoughts?
Well, Costco reported tonight, and Jeff's on that conference call, Jeff Marks, and, you know, it looks like they're going to do a special dividend. Look, I happen to love Costco, all right? But I think Walmart's good, too. And Costco was at its high, and Walmart's much lower. So I don't want you to sell Walmart. I think there's a lot still there. We will find when Jeff Marks has finished his wrap-up for Costco, because remember the club, we will know everything. So that's what I'm waiting for. But thank you for the kind words. Why don't we go to Jimmy in Massachusetts? Jimmy.
Hey, Jim. Thanks for having me on. I'm here with my fellow Westfield State finance students, Hannah and Eric. And we are wondering what your opinion is on Macy's with all the talks of buyout from Arkhouse and Brigade Capital.
Okay, so Hannah, Eric, and Mr. Jimmy, here's the problem. That stock has now had this run based on rumor. And I don't like rumor. I don't know what's going on. I do think the stock is incredibly cheap. But what happens if they come out and say, like, hey, we're not real. And then the stock goes to 17. And you and your fellow students are going to say, well, why did Cramer hose me? I'm not doing that. I'm not a hoser. Okay, Douglas in Texas, please. Douglas.
Hey, Jim. I think the market is wrong on airlines, especially United Airlines. I'm seeing United make $9 a share and only get a PE ratio of 4, while the industry is hanging out at 10. And like Southwest is making 78 cents, and they got a PE of 40. I know United has a lot of debt, but they're aggressively paying off debt and making more money per share than any of their peers, and have rapidly decreasing fuel prices while maintaining robust demand. Tell me why United shouldn't be trading between $80 and $100 a share, which would really only represent a PE of 9 to 10.
Well, I think it's inconsistency. A lot of times you wake up and you see that they cut numbers, which just drives me crazy. But I will grant you this. It's up 15% for the year, and I think it should be higher. I don't understand the PE disparity is wrong here. I think that Douglas in Texas is very much on to something. All right, the times, they are changing in this market. And now it's time for the laggards to start leading us, okay? The slow ones now will later be fast. Mad Money tonight. Chewy held its first ever investor day here at the New York Stock Exchange, and I learned a ton about some businesses that they're doing quite well in. Then Vertex Pharma shared a handful of positive updates on the pipeline. It caused the stock to jump higher. Is the run warranted? I'm going to tell you why I stayed on the stock. And then we've heard very different stories from Dick's Sporting Goods and Academy Sports on the state of their business. So which is the better one to buy? I will give you my take. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.